Another portfolio review, and worrying, this one. What we've got here is a ISA that somebody's managing for their mum, so they better get it right. And what's concerning is, so I've marked in red all the losing ones. Now, it's not unusual to have some which might be losing. The problem is, if you take the average loss, and of course they won't have invested the same amount of money in each equally, that average loss means they've generated a 3.6% return on average in those. 3.6 return. The NASDAQ was up 55% last year, and the S&P 500 was up 25%. Now, 3.4, whichever way you cut it, and of course they put different amounts in this, that's just a bad set of picks. There are some good ones in there, but that's not the problem. The problem is there seems to be a spray and pray, which has led to too many bad ones. So let's look at some of the bad ones. Well, BT was down 23%. Canadian, and then these things can happen. Canadian General, 21. The Buffettology, just because they say bloody Buffettology, don't fall for it. Minus 4%. Great, well done. So much for Buffett. He's not making minus 4%. And that wasn't a Buffett fund, it's a Buffett copycat fund. Citigroup, well, I don't have a problem necessarily with banks, it's just that you picked the wrong one. Minus 20%. I happen to own JP Morgan. If you watch my Telegram channel, you'd know. Mobico, down 65. Now that tells me there doesn't seem to be a stop loss process in this. And I'll come to that in a second on the flow chart I'm going to show. Pfizer, again, healthcare this year I'm not too worried about, but Pfizer's not the one for me on the healthcare side. Minus 25% suggests there's no exit strategy, and a bit of name recognition. Scottish Mortgage, I've done a video on my YouTube channel on why they suck. So that's minus 2%. Thanks very much. Like I said, the NASDAQ was up 55% and the S&P 25%. They're not good benchmarks necessarily, but this is an individual who has got, for instance, Costco, got a few things right. It's one I own, probably looked at my broadcast. That's up 57. They've got a Microsoft. So they're obviously interested in the US market, which Scottish Mortgage is supposed to replicate. So why is the performance so awful and dreadful on here? And Alphabet up 34. Why is the performance so underwhelming when there were a few which actually did well? Well, there's a couple of reasons this typically happens in portfolios. One of them is that they don't actually have an approach for knowing when to exit. As I teach my clients, we have a set time frame, and if in that time frame the stocks drop 25% from the highest they've been since we've bought them, then you'd look to exit. However, you might do it earlier if for whatever reason we become more risk averse, then we might do it earlier. Now, in this case, it looks like the individual, having suffered quite significant losses, hasn't done that, hasn't had a process for monitoring those, and has probably held them over 12 months in any event. And that's one key reason. The other reason is, why are there so many stinkers in there? I suspect there hasn't been a relatively sophisticated approach. We provide this data to clients where what they've done is, in their case, they've not looked at value. You can see at the bottom of the screen I've put there, they haven't looked at value, growth, income of the company's cash return on capital invested, 6-month performance, Sortino and Alpha. And once you've got a few of those, and you need all of those boxes marked green, so Harley Davidson wouldn't meet it for me, all of those boxes marked green, then that will tell you when to get in. It'll also tell you when to get out based on the flow chart. A simple process. Monitor it for 5 minutes every 2 weeks, and that way you've ticked the value, growth, income, cash flow, Sortino, Alpha boxes, and you don't have to be confused how long you're holding things. You don't have to be confused, do you sell it when it drops, and you wouldn't have as much red on there. It's not to say you won't have stocks which won't fall, but at least you won't have suffered a 65% loss. And I suspect the ones which are down 23 or 21%, that's not 25% down from their peak they've been, because they might have been up 20% and then dropped. So there isn't that robust process, and that takes 5 minutes to monitor every fortnight. That's it. So I think there's just a lot of things wrong with this, I'm afraid. I don't like the look of it. And it seems a bit of a spray and pray, and that's why the average performance has been so low. Okay, so there you go. When you just tot up the average of the percentages, like I said, they'll have different amounts in each of those individual stocks, but in total 3.64% average. Shocking, I'm afraid. Like and follow for more.